Hello and welcome to FFA NextGen's event, Spreading the Message, ESG's Rise in Fund Finance. If you have questions for the speakers at any time, please send them to Fund Finance Association. So I want to thank the panelists for dialing in. In the past year, we saw that the implementation of ESG in finance has accelerated rigorously. And there was no exception in the fund finance market. Today, we're honored to have four panelists who will provide their unique perspectives on the development of ESG in fund finance, as well as in the broader financial markets. First, let's have our panelists briefly introduce themselves. Wes, would you like to start?
Sure, Annabella. Thank you. I'm happy to start off. I'm Wes Misson. I'm a partner at Carlisle. I co-lead our US-based fund finance practice, and I also lead the firm's ESG initiative for the finance group.
Jose.
Good afternoon, everyone. Jose Lesponcion. I'm a director in Bank of America's Section Finance Group. Been with Bank about 10 years now and have done 3 of our ESG-linked facilities.
And I'm Chris Bitsoff. I'm a principal on our fund management team at Carlisle. I lead the day-to-day operational and financial support for our US buyout funds and also oversee Carlisle's America's corporate private equity subscription facility. So thanks for having me here today.
Hi, Harlan Singh. I'm the Global Head of Sustainable Investing for Citi's Global Wealth Platform. I work closely with all of our product areas as well as our bankers and investment counselors globally to work with clients on their strategy around sustainability.
Thank you, everyone. To start, let's talk a little bit about the structures of ESG-linked subscription facilities. So Wes, I believe Cadwalader has closed 6 ESG subscription facilities to date, and you've published quite a bit on ESG recently. Between the 2 types of ESG-linked facilities, namely use of proceeds and performance-based, it seems like performance-based subscription lines are more common these days. Do you expect the demand for use of proceeds facilities to catch up in the future?
Yeah, that's right, Annabella. We've been seeing a big surge in ESG overall. You know, I would say that we started talking about these deals last summer, and then they came across our desk end of the year 2020, and then we closed the first one January of 21. That acceleration has continued. Performance-based facilities do tend to be more popular right now, but I think the demand is going to come back, and we're going to see a lot of use of proceeds facilities in the end. You know, it's a small sample size. You know, we've closed 6 facilities overall. We're working on another 4 right now. So it's kind of hard to really gauge that. But I think the reason that we're seeing more of the performance-based structures is because of the flexibility it provides. So you can structure a performance-based facility for any fund with any asset class. The performance-based facilities establish sustainability targets that align with the fund or sponsor's overall broader ESG strategy. And so it's not specific to the fund, doesn't have to be. You can then set key performance indicators to measure the performance against these sustainability targets. And you've got flexibility on how you set them. They could be set at the fund level. They could be set up above at the management level. You can set them below at the portfolio company or the investment level. And so again, there's lots of flex in terms of what you can do. Use of proceeds facilities, on the other hand, are a little more restricted in how you structure them. So generally, all of the loan proceeds have to be used for a permitted purpose, and that's going to be investments that qualify under agreed upon sustainability or green loan criteria. And so obviously with that type of structure, the usage of the facility and the type of fund have to align. So the fund has to be of a particular asset class and strategy in order for that structure to work. So typically what we're seeing in that space is more of the E in ESG. So the environmentally focused funds, clean and renewable energy funds, climate change funds, and the like. It is possible, and I think this is an important feature to note, you can structure a use of proceeds facility that also has a component where the proceeds are not used for sustainability type assets. However, when you do that, and we haven't seen very many of these to date, you should tranche it out, right? So you've got a specific tranche on the sustainability portion for those investments, and then a tranche that is used for the non-sustainability portion. And the reason for that is you want to be able to clearly track the proceeds, you want to have greater transparency, and you want to maintain the integrity of the whole structure. In terms of, will the use of proceeds type feature catch up in the market? The reason I think it will is because if you look at what's going on just kind of broader, like big 30,000 foot view of the market, you had over $50 billion of investor money pouring into specific ESG-focused funds last year. And these are exactly the types of funds that are going to demand these facilities in the future. And so that's going to be a lot of demand out there for funds that are going to need financing.
So speaking of performance-based facilities, do you see a market standard for this type of pricing adjustments emerging on the lender side?
So is there a market standard for the pricing adjustment? I would say no. And that's really kind of, goes hand in hand with the overall message. And the beauty of ESG is it's not one size fits all. And it's really quality over quantity. And it's about achieving the greatest good and working together collectively to do that. And so there are lots of facilities that don't have pricing adjustments at all. And then there are plenty of facilities that do have pricing adjustments. And the ones that do, I would say the market is falling somewhere between 2.5 basis points at the low end and 25 basis points at the upper end. And it can toggle at various increments. It doesn't have to happen immediately. You don't have to, wait a full year necessarily. You can have multiple KPIs. You can have pricing adjustments up and down upon achievement or failing to achieve certain KPIs. And then, as I said, there are lots of facilities that simply keep the pricing adjustment out of it, and that's okay too. I will say, though, one of the trends we've seen develop, and this is probably going to continue, is it's really been a one-way adjustment, so downward in terms of if KPIs are being achieved, you're seeing a pricing reduction. And then if there's failure to meet the KPIs, pricing at the next adjustment date is going to go back to the original pricing on the facility. We're not seeing a lot of pricing increases in a corresponding amount with a toggle up if you fail to meet the KPIs, although there are some facilities out there that have been closed and structured in that fashion. And I think it's important, it's a structuring feature to keep in mind, because most often you're not going to make an event of default be the remedy for failure to meet the KPIs. And the rationale for that is you want the targets to be meaningful and ambitious. And so if a borrower knows if it fails to meet a KPI, it's going to run into a default, it's less likely to be able to set meaningful and ambitious targets that are going to accomplish what we're all setting out to accomplish. But by having a pricing toggle, that's another way that you can do it and incentivize the behavior. In the end, though, as I said, it's really quality over quantity. It's about working together to achieve the greater good and a more sustainable future.
Jose, from a lender's perspective, what factors do you look at when you're determining pricing for ESG-linked facilities?
Sure. So Wes hit on a lot of the topics, and I think the primary one is to set the targets that you're focused on and then go from there. So once you have a framework and you have targets in mind, you can start thinking about your KPIs. And as he mentioned, the primary thing we're solving for here is how ambitious are the KPIs and how achievable are they in the tenor of the facility. That said, he mentioned a broad range, and that's definitely the case. As we look at pricing for any given loan, we're looking at the margin, the break, the unused fee, the upfront fees. So some clients have a preference for a higher nominal margin and a bigger break, and some have a preference for a lower base case margin, if you will, and a smaller break. So I think over time, you'll see those breaks fall more in line with, if it's an environmental focused fund, for example, it's within this range. If it's social, it's within this range. But for right now, I think people are still figuring it out.
So speaking of the different factors within ESG, Wes, in the structures that you've seen so far between environmental, social, and governance, which aspect of ESG has been more focused on these days?
Yeah, so Annabella, I would say between environmental, social, and governance, it's been fairly balanced. But again, we've got a really small sample size to kind of look at. So it'll be interesting to see how that shakes out over time. But just looking at the deals that we've got. So in the 4 deals we're doing currently, 2 are the E, and the other 2 are the S and the G. And we often see convergence of multiple components of ESG in one deal. And so particularly with social and governance, that's been happening, as are triggered based on, say, gender or racial diversity for boards. But it's also interesting to kind of look at the market and what's driving this, right? And what's driving a lot of this is investor demand. And so Preqin actually did a survey with investors last year, kind of asking them how they rank the 3 components. And the number 1, although not by a wide margin, it was 62%, was the environment. So the other factors are there, just slightly behind. That said, I do think we're going to see more social goal-driven facilities in the future. It's just, given the amount of money that's pouring into social impact funds today, there's no way that's not going to happen.
Thank you. Now let us dive a little deeper into how an ESG-linked subscription facility is structured. Chris, I know that Carlisle recently put in place a $4.1 billion ESG facility with Bank of America as the sole lead arranger. This transaction, I believe, would be a great case study for our discussion. For those who haven't heard about the Carlisle deal already, could you give us a brief recap?
Sure, happy to do so. So in February, Carlisle announced it has secured the largest ESG-linked private equity subscription facility in the U.S. for $4.1 billion, and the first to focus exclusively on advancing board diversity. It's a 3-year facility for its America's corporate private equity funds, with interim targets for board diversity leading up to our goal of 30% diverse directors for all Carlisle controlled portfolio companies within 2 years of ownership. So as our funds hit these goals, the idea is it unlocks a cheaper cost of capital. And so for our portfolio companies, the facility further progresses our board diversity and stands to make a tremendous social and financial impact within the organizations and the broader communities they touch. The idea for this facility came about as diversity has been an extremely important area of focus for the firm, and as well as action by the firm. Along with other initiatives, we set this 30% diversity goal for our CPE controlled portfolio companies and wanted to tie that metric in to this facility so that it aligns with the firm. And it is important to us, it leads to better decision making, not only the firm, but our portfolio companies. And as we put our heads together to think about how to hold ourselves accountable, and also set an example in the market, we specifically focused on this metric. We believe that board diversity contributes to effective and innovative decision-making processes, as well as financial outcomes. And our data shows that over the past 3 years, the average earnings growth of Carlisle portfolio companies with 2 or more diverse board members has approximately 12% greater per year earnings growth than companies that lack diversity. So we're excited about this, and it's the beginning of an evolution in subscription finance, and we believe there's a lot more work to be done.
Aside from board diversity, what other issues do Carlisle and your investors prioritize when it comes to ESG and sustainability?
Sure. So at Carlisle, impact is not just a product, but part of the firm's investment process. It's the lens for finding efficiencies and capitalizing on new growth as the market continues to value a wider set of business competencies. And so as we look at ESG throughout our processes for our portfolio companies, we incorporate this in, and including our customers that work with our portfolio companies. So ESG is part of our due diligence processes as we consider new investments and over our investment holding period. And we strive to help companies no matter where they are on the ESG spectrum. And so for portfolio companies, we look at angles that are unique and important to that company and helping them create an appropriate strategy. And to our funds, subscription finance is another avenue to increase that accountability. and it aligns incentives to build more sustainable businesses and to drive that change. And then for our investors, it's an important component in diligence and provides transparency into how we're looking ahead in the ESG spectrum, advancing some of these goals and converging our investment thesis between the operating models of the portfolio companies at the intersection of the E, the S, and the G. And so the issues that we face with our portfolio companies are going to change over time. And it's something that I'll quote from our head of impact here at Carlisle. It's dynamic materiality. And the idea is that we need to constantly review and evaluate what is critical and not just focus on static data. And to help do so, we need a critical mass of companies disclosing the same data to drive down the costs and open up new growth markets. And so for us today, board diversity has been that primary focus with the biggest impact.
Thank you. Jumping back to Jose for a moment to get the lender's perspective. Jose, what do you consider when you're negotiating KPIs in an ESG-linked facility?
Sure. So as Wes and Chris mentioned, it does vary by ES or G. So BofA has closed green loans, social loans, and then our Carlisle governance linked facility. So once you determine the primary pillar, you can go from there. We've only done deals focused on one of the three pillars to date. I'm aware that certain lenders, certain deals have had two or more pillars incorporated, each with different KPIs. But I think we go back to the same overall thesis here is that the KPI should be measurable, should have impact, and should be achievable. And as Chris mentioned, that varies by fund type, it varies by client, and varies by loan tenor. If you're doing a 3-year deal, it makes sense to have them be a little more aggressive in 3 years than if you're doing a 1-year deal that's a shorter fuse. But I think as Wes mentioned, we want to have the client succeed here. So it doesn't do anyone any good to say the level, you guys are at 30% today, we want you to get at 85% in 3 years. That's not going to happen. So something that makes sense in the tenor of the deal.
So I'd like to further this discussion on how to ensure goals are ambitious and meaningful. Harlan, having seen various ESG products in the market, how do you identify greenwashing and from a lender's perspective, ensure these sustainability goals are ambitious and meaningful?
Yeah, I mean, that's a really great question and something that comes up a lot, right? So for investors, for individual investors, which is essentially, and family offices, which is essentially where my focus is, greenwashing is a huge concern. One of the areas that we do see some greenwashing, especially in the public equity space, is around companies that are setting net zero targets. And so similarly with private capital and what we're seeing, with financial sponsors is, are these goals meaningful? Would they have happened anyway? Right? So are they getting this kind of green label for a goal that would have been met without it? So certainly investors are concerned with the determination of whether or not the goal itself is meaningful, and then whether or not it's achieved. And so for many investors, it's using external auditors to really ensure that whether it's an environmental goal or a social goal, that it's met. And we're seeing, a lot of activism in the public markets. For those of you who have been following this year's proxy season, investors are getting very focused and very involved with companies and in ensuring that they meet these goals. What else we've been seeing? So on the borrowing side, many companies are raising debt capital in public markets as well that have KPIs linked to them, both in the E and the S. For the most part, very, very little that we're seeing in the G. And they're setting, some of these targets as more shorter dated targets where there's progress being evaluated towards a, say, 2050 net zero goal. But I think investors are really concerned about this. And when you look at some of the managers who are managing portfolios of companies that may have KPI linked issuances outstanding, they're not necessarily considering them for, say, a green bond portfolio. And the reason is that is some of this, right? So some of the risk around greenwashing and also the risk around owning these assets as an ESG investor and say that target is not met. there is always that risk. I think probably everyone on the phone here will say that most borrowers do achieve those targets, but there's always the risk of not achieving it. And so then what does that do to the investment? Does it still qualify as an ESG investment? So, I think there's still a little bit of kind of, I think maybe Wes mentioned this earlier on, in terms of everyone or every investor and every issuer and every raiser of capital has their own view on what is sustainability and what qualifies. And I think some of that reconciliation between what an investor is looking for versus what a company might articulate as their ERS goal needs to happen. So the transparency piece of it is really important. I think for many investors, greenwashing is as good as transparency. And if the transparency exists both around what is the KPI, how it's going to be achieved, and then having some sort of an independent audit around it, gives investors more ease.
Thank you. So there certainly has been a lot of interest in understanding how these KPIs are monitored by the lenders. Jose, within the bounds of what you're able to discuss, could you share with us how Bank of America implements KPI monitoring for ESG-linked facilities?
Sure. So what we've been successful at to date is working with our clients to incorporate that in the ongoing quarterly compliance reporting. So ideally, it comes with the source data so we can figure out how the levels are calculated. In a perfect world, that same source data is publicly available. So someone can go and look at their annual report and find the same information and get to the same levels. But that's worked out well for us so far. The bank groups have been accepting. We've done ESG-linked deals with something like 20 banks, and it's worked to date.
So stepping away from the fund finance world for a moment, Harlan, you've had extensive experience in impact investing even before you joined Citi. Can you tell us what were the major factors that propelled the incorporation of ESG in the private and public markets in recent years?
Yeah, I mean, one factor is obviously data availability, right? Increasingly, we're seeing companies report on this data. And then secondly, we're seeing, I think one of the things that comes up a lot is millennials and women are attributed with having driven this move towards ESG. As a female and borderline millennial, I don't think I quite made the cut. I push back on that statistic a little bit. That's not to say that women and millennial are not interested, but I do think that investors broadly have become much more interested in how the companies they're invested in do business, as well as what the companies they're investing in do business. And the reason I say that is, especially over the last 18 months, when we've seen kind of this work from home environment where we've seen economic and financial injustices being perpetuated, especially in already kind of low income communities. We've seen the impact, when I think the first couple of months when we were all kind of locked down at home, we saw the skyline in India, you could see the Himalayan mountains, you could see the air clear up, you saw the air over Los Angeles clear up, right? And people were really all of a sudden refocused, re-energized around climate. And with the Black Lives Matter movement in the US, racial and social injustice became front and center. And you kind of asked a question earlier around what do people care about? Is it the E or the S? And, I think it's both. And I think it's very much around equity. It's around climate and climate equity as well. From an investor standpoint. So, I think the availability of data, as well as the supporting evidence of not having to compromise financial returns in order to invest in a way that incorporates ESG factors, or invest in a way that has a positive societal impact. One funny kind of thing that comes up a lot is people, there's still kind of this idea that either you're an ethical company or you're financially viable or you're profitable. And I think increasingly people are starting to realize that you don't need to be unethical to make money. As a matter of fact, ethical companies perform better in the long run. We're seeing already the implications of climate change, both physical risks associated with climate change as well as transition risks. The regulators are coming in to step in and ensure that companies are making the transition appropriately and in a timely manner. So, that's all to say that over the last few years, we've seen really a coming together of stakeholders. So not just climate change activists who are looking for companies to do the right thing, but consumers are asking for products that are manufactured in a more ethical way. There's been a lot of heightened focus on things like fast fashion, and now increasingly a focus on circularity and how recycled waste can be used actually as product, whether it's a pair of shoes or a jacket. And I think, all of that coming together is really starting, and then the events over the last 18 months have really started to accelerate this move that was already happening in a timely fashion, because we don't have a whole ton of time to achieve net zero, and we don't have a whole ton of time to address some of these larger societal issues.
So it seems like we expect the ESG trend to continue to thrive in the coming years. Do you think there will be a distinction between traditional investing and ESG investing, or will ESG be fully integrated as the norm?
Yeah, so that's a great question. And I put myself out of a job every time I answer it. My view is that ESG at the bare minimum as a risk factor will be integrated in every investment decision making. I think that if you're ignoring the risks associated with ESG factors and ESG metrics as associated with an investment, you're really doing yourself, you're doing a disservice to the way that you're evaluating an investment. So I think probably every investment decision maker and every investor will in some way integrate this data into their portfolios, into their investment decision making, whether it be as a risk factor or a way to identify alpha. So this year, for example, in our market outlook, we actually kind of started last year, we announced greening the world as an unstoppable trend, purely based on the fact that there's an opportunity here to derive financial returns. So I think, the world is changing. There is now more availability of this data for investors to make decisions, and ignoring it would kind of just, it would be ignoring any other risk, right? So you're taking into account all sorts of risks in investment decision making, and this should absolutely be one of them. That said, I do think that there will still be a delineation between integration of ESG risks and deriving alpha using ESG factors or ESG topics. So the thematic and the impact investing, I think, will still kind of have their own, call it, approach, right? So you'll still see newer investments. I think KPI linked products have been newer, right, to the market, and we'll see continued development around that, and development around new ways to drive capital to areas of the UN Sustainable Development Goals that are necessary. So I think you'll see kind of a split.
Chris, do you share similar views with Harlan on this?
I do, and in my opinion, traditional and ESG investing has already begun to converge, and I expect that trend to accelerate. And there's no doubt that this market will continue to grow larger. ESG isn't going anywhere. We're in the early days of evolution and financing, where ESG will become more intertwined in various aspects of the investment process. And sustainability agents will play a bigger role in subscription finance. One of the ways that, or one of the keys, is identifying metrics that are measurable and meaningful metrics, as we talked about earlier, that can be applied across companies, and then also be able to incorporate bespoke metrics for each portfolio company. And when we started working on our ESG facility, we wanted to focus on what we believe to be the most material metric that impacts change, decision-making, performance. And that's why we selected diversity. And that's a start. We wanted to keep it simple, realizing the US market is still in its infancy, and where adoption of this idea across a broad syndicate, we believe, could be widespread and could garner the support for an innovative product like this, and also be something that's materially impactful. Like there's definitely a lot of issues to tackle across the ESG spectrum. And as we discussed earlier, we want to identify which ones are the most impactful. And when originating such a facility, we need to balance that level of complexity across these different issues with respect to tenor, as Jose mentioned earlier, and with the bank syndicate and the processes, and make sure that we have an efficient reporting process, but it's also impactful and aligns with enhancing the sustainability of companies.
Thank you, Chris. We've gotten an extensive list of questions from the audience, so we'd like to answer a few. The first question is, how do EMEA and Asia compare to the US in the incorporation of ESG funds and financial products? Perhaps Harlan and Chris could take this.
Sure. Yeah. I mean, EMEA, I think, has far long been the leader in terms of using, particularly around the environment and climate. Regulations in Europe are also pushing companies. Any company that's domiciled in Europe will need to report on, I think it's like 30 odd indicators as it relates to ESG. So they're mandating it from both the regulatory side, and then there's a pull perspective from the consumer and investor side. Asia, I think, when you look at the policies in China, even Hong Kong and Singapore, they are similarly moving in line with Europe. China's net zero by 2060 commitment. There are some views that they might actually pull that a little bit forward. So they're obviously making a significant investment into clean tech, clean energy, sustainable infrastructure, et cetera. From the investor standpoint, it's interesting. I think that when you look at the investor standpoint, you kind of have to break down the segment of investors. So institutional investors for a very long time have been leaders in sustainability in Europe. However, in Asia, we've also seen GPIF was one of the earlier adopters of ESG in their portfolio. They're the largest pension, Japan's largest pension. We're starting to see institutional investors obviously take the lead in Europe. And as far as individual investors and families and the way that they're viewing these investment opportunities, my experience at Citi has been that we're seeing pretty much equal kind of attention to these areas across the board. The difference is a little bit more in terms of the product that investors are interested in. In Europe, we're seeing a lot more focus on the environment. In the US, a lot more focus on racial justice and social equity. So, I think thematically, there are a bit more differences for individuals and families. But, for the most part, we're seeing pretty strong interest across the board in all regions. In Asia, a lot more interest in impact investing. So rather than kind of this integration of ESG across the board, a lot of focus on specific themes and specific areas of impact.
Just echo that. In subscription finance, specifically, my view is the subscription finance market in Europe is a bit more advanced in structuring some of the governance, pricing mechanics, but also kind of a lens a little bit more toward environmental, whereas the US a bit more kind of social and governance. But I think, broadly speaking, that these themes are all converging and moving in the same direction across Europe, Asia, and the Americas. How the data sets are used may be a little bit different as well, but all trending in the same direction. And then, in the use of proceeds, for example, we're seeing, one example of that is, revolving credit facility where, if proceeds are used for general corporate purposes, that the company will get market rate debt. But if the proceeds are used to replace equipment that's more efficient, then that'll unlock a cheaper cost of capital.
Thank you both. Another question that we got from the audience is on the regulations of ESG-linked loans in the fund finance industry. Wes, could you tell us more about the existing regulations and what's in the works to address ESG compliance?
Sure, Annabella. I think, we're still early stages on this and there's going to be a lot more to come, but I would say that the big one right now, big one to watch out for and the key takeaway is third-party verification. So Harlan touched on this quite a bit when she was talking about greenwashing. I think it is a concern out there, and the APLMA, the LSTA, and the LMA collectively have put out guidelines in terms of how these facilities should be structured if they're going to be structured as what we call a sustainability linked loan program. And so in the guidance they put out, they originally put this out in 2020. They revised this a couple of weeks ago in the May 2021 version that just came out. And the key change there, if you're doing a sustainability linked loan facility, is to have this requirement now for independent third-party review and verification. So either a auditor, a qualified auditor, a consultant, or a rating agency should be engaged to verify the performance of the borrower against the targets and the KPIs at least once a year. And then the banks would use that information. It is important to note that facilities that were done, I think it was prior to June 3rd of this year, are grandfathered in so long as they follow the prior guidance and the SLLP, and also use the proceeds facilities. So more commonly the green loans continue to fall outside the purview of that requirement for third-party review and verification, although it is recommended.
Thank you. Another question that we got from the audience. We have time for, so what would the panelists like to see in terms of developing ESG in your respective area? Maybe Jose can start.
Sure. So I think the big thing as the panel has mentioned is that this is a growing area across the board, not just in this space, but also, capital markets, private debt issuance. So I think the biggest thing is just to coordinate with people internally that are doing the ESG framework, either the bank's own investing or initiatives and projects across the board. For Chris's deal, for example, we coordinated very closely with our ESG capital markets team. And it was a hand-in-hand coordination between our team and the product side and their team to get something that made sense. So for anyone in this space that is interested, just make that known and coordinate with people that are getting the exposure from other industries and other products.
I don't think any conversation about ESG would be complete without talking about data and the availability and consistency of reported data around ESG. I think one of the tougher components is ensuring that you have consistent data across companies in order to evaluate them as it relates to their ESG, call it footprint. So I think that would be probably on all of our wish lists.
Yeah, I would echo Harlan on that. I mean, this is going to be a topic that we'll have to work together across, sponsors, capital providers, and it's clearly an increasing area of focus. And we'll have to balance that level of ensuring consistency in reporting, but also being able to ensure flexibility across the syndicate to be able to provide those meaningful metrics and be able to report on those.
Wes?
Yeah, look, I think, ESG is certainly not going anywhere. And I think, in fact, this is going to be a permanent fixture in our industry for years to come. You simply can't ignore, you can't ignore it. You can't call it a trend anymore. 69% of fund managers have already, established an ESG policy or are currently working to do so. And, Chris mentioned certainly the view that Carlisle has on this. And I think it's shared by investors. And, 89% of investors think there's a positive impact, not only with ESG investing, but also with respect to returns, that the returns are going to be as good, if not better, through these ESG strategies. And so, look, I don't think this is going away anytime soon. And I think it's good to have these conversations. So we all understand and can work as a market to structure the facilities.
One more question for Chris before we end. Aside from subscription finance, subscription facilities, does Carlisle implement ESG in other types of debt financing?
That has been, that's a great question. It's an area of focus for us, and one that we're continuing to explore as the market continues to evolve. Yeah, I mean, there's a lot of different ways to evaluate this, but we are actively reviewing that.
Before we end the panel, could each of you give some advice to the young professionals who are interested in pursuing a career in law or finance with an ESG focus? Are there any resources you think would be helpful to keep up with the fast-paced development of ESG in the finance world? Wes, would you like to start?
Yeah, happy to. I think the great news is we're still in the early stages of the development, particularly in the US. I mean, Europe is further along as we've discussed. And so that means there's a lot of opportunity. So there's a lot of opportunity for younger professionals to get involved in this. The advice I would give is find the individuals within your organization who are leading the ESG effort, who are the experts in the area, who are, setting the trends on this, and seek them out and ask them if you can help out, if you can work on one of these facilities, if you can work on a project that's ESG oriented. I'm sure they'd be happy to mentor you and would love to get you involved. In terms of resources, certainly if we're talking about regulations on ESG, investing, not just in fund finance, but kind of more broadly in the market, the Cadwalader Cabinet is an excellent resource and kind of a one-stop shop you can go to for all regulations that are out there. In terms of what's going on in fund finance and how that's affecting our market specifically and how we're structuring facilities and the like, Fund Finance Friday is a great resource to go to because we're continuing to link tons of articles across all industry publications on FFF. And so again, it's a great one-stop shop to kind of keep current on what's going on.
Jose? Jose, any advice?
No, so I think Wes covered it well. Just make it known you're interested, find people internally that are doing the same thing in different products, and keep up with the trends. I think the good news is, I think Wes mentions that we're very early, and the deals that we're doing today, that we've done to date, and the deals that we do in years through time may look very different in terms of frameworks and reporting and what people care about. So I think getting started now is a great time.
And Chris?
Yeah, I would say a couple of things. One, it starts with an idea to make an impact. Don't be afraid to have a conversation with bank or banks to test the waters on an idea. We mapped out the idea for Carlisle's ESG facility on paper, developed the framework around it, discussed the idea and iterated it internally, and then discussed with the bank, iterated some more, discussed with the syndicate, who was very supportive, and brought in counsel to help to put it on paper and to get to an agreement. And don't be afraid to push the boundaries. Again, thinking about a common theme from this conversation today is what is meaningful, how do we measure it? Obviously, data is going to be extremely important. There are a lot of issues, and we need to figure out how do we solve those. And there's so many that focus on the ones that are most material. And the idea is to constantly work towards continuous improvement and sustainability, and to see some sort of improvement. There's not always going to be clear answers for everything that we're facing. As we diligence companies, acquire them, we're looking to align goals and make good decisions that are going to have a lasting impact. And that's how it starts to create change, is one company at a time.
And lastly, Harlan.
Sure. So as I think everyone else mentioned, 70% of what you learn on the job. So I think everyone's advice has been really good in terms of trying to figure out ways to get involved in your respective organizations. But for those of you looking to potentially add some of that academia as well, alongside that, the CFA Institute now has an ESG curriculum, which I believe they're rolling out globally. It started in the UK. There is US CIF also has a type of certificate around ESG investing. There are a number of really great books that have recently been written. Bill Gates wrote one of them on climate. Sir Ronald Cohen wrote one on impact weighted accounting, which I think is a really interesting concept, especially when it comes to the development of an accounting principles similar to kind of GAAP principles, but in impact. That could be really great resources for you. So I think, as you think about kind of developing some of these skills, some of it, obviously the majority of it will be done within your current roles and where you can get that kind of on the job training. And then the 30% gap in terms of, looking into some of either the certificate programs or some other academic literature around the topics. Because there's still a lot to do, right? As you said, it's fast developing and it's going to continue to develop. So there are really great opportunities for young leaders to be really influential in this space.
Absolutely. Well, thank you very much, Wes, Jose, Chris, and Harlan, again, for your time and everyone who dialed in today. We covered a lot today on ESG, and I hope you found this panel informative. Please feel free to email us your feedback and tell us what you'd like to hear about in future events. Thank you.